Are markets around the world about to get really scary? Yields keep rising across the curve, and certain economists are even forecasting a 5.5% 10-year yield. Today, we talk about volatility and how it's underpinning this entire market, bringing the bears back. And of course, we got to talk about max paying OPEX. But the question we really need to answer is what happens if technology falters? With the S&P 500 failing to make a new high, Jerome Powell's very hawkish comments about inflation, as well as Tesla's horrid earnings, we need to talk about the worst case scenario. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe and hit the notification bell. Let's get into it. It was a sea of red everywhere. Microsoft held up technology for the most part, but other than that, it was a pretty brutal day of selling. There were some pockets of green. TSM reported better than expected earnings, as well as some SaaS companies catching a bid. Energy performed better than expected, and Netflix soared on amazing subscriber growth. Fear is coming back into the market. The fear and greed index was closer to the neutral mark than it was the extreme fear just a couple of days ago, and now we're pushing back into this situation right here. What were the best sectors today? Communication services on the back of Netflix had a 0.3% increase today, but other than that, it was a pretty brutal day. Financials, consumer discretionary, and real estate saw most of the selling. If we look at sectors on a 5-day average, that XLE and GDX were the obvious outperformers, as well as consumer staples did have interest rate sensitive stocks all moving lower in the last 5 days. This is the earnings calendar so far for the week. We had Netflix and Tesla, the big ones, report yesterday. We did have TSM report today, as well as Union Pacific. They produced pretty good earnings. Now, how are companies doing? And this is we can see here that based on Q3 earnings so far, about 20% of companies in the S&P 500 have reported earnings, and so far the earnings season beat rate is 68%. 107 beats, 51 misses. And it's all going to come down to next week. Some of the biggest names are reporting next week, and a lot of the earnings and earnings growth are in these big companies. We have Microsoft and Texas Instruments reporting on Tuesday, as well as Coca-Cola and Verizon on the same day. We also have Meta, Boeing, and IBM reporting on Wednesday. And then we have Intel, Ford, Chipotle reporting on Thursday, and then we also have some of the big energy names on Friday, ExxonMobil and Chevron. So it's a very big week next week for earnings, especially with Microsoft, Meta, Coca-Cola. These are very big names that are really going to move the market if they miss or if they beat. Now, breadth in the market, we spoke about this yesterday. Breadth is very low, and that's because we all know that this market run, this rally we've seen from August, October last year, the start of this year, all the way to right now, we are up for the year, has mostly been on the back of the mega cap 7 and the mega cap 50. Breadth normally is around this 35 mark. Right now we're sitting at 10. If we continue looking at a breadth analysis, we can see here that this is the S&P 500 above their 20-day moving average, and it's about 35% of stocks are above their 200-day moving average. And the last time we were this low was pretty much last year this time, as well as November 2021. Now, this is the bullish percent index. This is actually an indicator we looked at all last week to see if we had formed a bottom, and we did find a bottom right here, and we did see a rally. We did say buy the dips into it, and we can see here that normally we get some upward action and we do get some capitulation towards the downside before we continue. I do believe that we are going to have a year-end Q4 rally. I've been very bullish on this. I've been very open about this, and I do see this just as a minor pullback before we rip higher into November, December, and even January next year. But this is all going to depend on what rates are going to do in the future. And we can see here that the 30-year bond and the 10-year note saw some very bullish action today, reaching yields of 5.1 and 5%, closing the day at 4.99% yield, which is absolutely crazy. And we can actually see here that the short end of the curve, their actually rates are decreasing. So this is really good. So shorter rates are coming down, longer rates are going up, which means that yield curve is uninverting, which is a very good sign. But rates are moving higher as a whole. If you look at 5-day basis, on a 10-day basis, on a monthly basis, both the 30-year, the 2-year, and the short end of the curve are all moving higher. So the curve is steepening, and that doesn't bode well for rate sensitive stocks. Now, looking at Fed fund rate futures, we look at this chart a lot. This is the updated one. Up until yesterday, the market was pricing in 3 rate cuts for 2024. Now it's only pricing in 2. And this means that we're probably only going to see rate cuts as early as April or May 2024, before it was possibly February, March. But we also are expecting one more rate hike before December, potentially as late as January 2024. Seasonality is on our side, guys. I see a lot of people talking about this is the start of the next bear market. No, the sell-off we're seeing right now is all within seasonals, okay? We are sort of at this area right here. Normally, in a pre-election year, we have a run up, some muted action, then we actually do sell down, and we actually from here do see a run up into the end of October, November, and December. Now, another chart I wanted to bring to you is the NASDAQ Q4 rally. These are just some statistics I found and some really, really great statistics right here. And this is 40 years of data. And we can see here that from the October low up until the November, December high or year end, the last trading day of the year, the NASDAQ on average has returned 9.5% up until year end, and at the high 13.1%, with the best Q4 rally ever being 54.5%. These stats have come at a very high clip. You can see a 98.1% win rate and 88.5. Now let's get into some unusual options activity. We saw the usual suspects, as you could have assumed, Tesla, huge amounts of puts against calls coming into Tesla, 2.6 times 90-day volume, as well as IWM, which has been here a lot in the last couple of days. We did see, I believe, the highest volume day ever for TLT. I saw someone on Twitter say it was the most amount of volume ever. We did see 2.8 times relative 90-day volume, as well as 100 million puts to 49 million calls. Taiwan Semiconductor, 5.3 times 90-day volume and huge amount of calls against puts right there. We had some very, very large volume, 42 million contracts, and expect it to be even bigger tomorrow. With the average daily is 39 million, and we did see 51 puts and 49 calls. This did come down a bit. It was 53, I believe, yesterday, with most of the volume coming in consumer cyclicals and financials. I also wanted to bring this to your attention right here. This is the S&P 500 last 10 pre-election years, 1983 to 2029. A pretty big data set considering pre-election years only happen once every 4 years. According to Seasonality, this is where we are right now, is normally when the market bottoms for the Q4 end of year run up. And this is why I'm insanely bullish, because we are well within seasonality. There's no reason to fear a massive bear market at the current moment. We are well within pre-election year seasonality. Obviously, this could change at any moment, and we are heading into a time when rates are a lot higher. But you have to understand that from 1983 up until 2007, so most of the time right here, rates were at where they are right now, about the 4.5-5% level. Again, this is seasonality with the interest rate environment we're currently in. Now let's get into some dark pool trades, guys. And this is the S&P 500 on the day today. We saw massive trades right here, a very weird trade at 425, and as well as a late print that came in. If this is a late print, it probably happened around this area right here. We do know that max pain is around the 430 level, so we could see a bounce into there. But the markets are digesting a lot of news, especially what Jerome Powell said. So you really have to be reactive and selective with the positions you take over the next day. And don't forget that OPEX is also tomorrow. Let's go to the Qs, and we can see huge amounts of trades happened right here. The Qs just got massive amounts of buying, and we do know that 367, this huge high right here, is max pain. So unless market makers get this price up in the next day's trade to there, it's not going to bode well for them. And we did see a trade right here, which was likely a sell. Looking at the IWM, and very similar to the QQQ, we had some trades come in here, all here, and we did see some trades in here as well. We do know that max pain is at 177, so it's well above these highs right here. So based on where max pain is and max pain theory, we could see a bullish action into tomorrow's OPEX for both the Qs, the S&P 500, and the IWM. Just focus on risk management, guys. Don't take it as it is, because the market we're in right now is insanely volatile, especially with the VIX hitting 21. Thank you so much for watching, guys. I appreciate every single one of you who's here with me and who have subscribed. If you don't mind, please like, comment, share, subscribe this video. Thanks so much for watching.